Welcome investors to Joe's Investment Express. Let's talk some more about VCPs. You will note that I have my Peaky Blinder hat on again today. I had it the second good market day in a row in my portfolio, so I thought I guess the hat's bringing me good luck. So let's keep it going. I'll keep the hat on until I have a down day in my portfolio, which is probably going to be tomorrow now that I've said that. But yeah, let's talk some more about Mark Minervini's trademarked volatility contraction pattern. As the name suggests, volatility contracts throughout the pattern. Once you have some practice recognizing these, they're not too hard to find, and they're a lesser known pattern. There are not going to be as many eyeballs on these patterns, and therefore I think they have more stealthy and gradual accumulation and lead to having really good results. So yeah, let's expand our repertoire beyond your grandma's cup with handle. And please, so what I'm going to do, let me show you a few from history. I'm going to show you an Amazon one from New Technologies, one from Apple, one from Tesla, another one from Tesla, and then I'll show you two that are actionable, BLTE and IMXI. And you might want to go back and watch my first video on VCPs, either after this video. Oh yeah, after the video. I'll link it. I'll put it in the comment section and at the end of this video. So, before we begin, as you know, this is not financial advice. This is just for education. And one thing you might consider doing is I post these videos very sporadically, so you might consider subscribing so you get notified the instant one of my videos comes out. All right, so let's look at volatility contraction in the very early days of Amazon, August 1997, the IPO. And what we are just looking for is the volatility to calm down and contract and settle down, for the volume to drop off, and for the weak hands to shake out, and then the stock takes off. And so you measure, and once you get good at this, you can just measure with your eyeball. But let's use our measuring tool to make our point here. So here's the IPO base of Amazon, July 1997. And if we measure here, the initial fall was 50%, and then we see 17%, and then we see 13%. And see how it gets really quiet here, even with this volatile day towards the end of this volatility contraction pattern. It was only 8%. So the volatility goes from 48% to 7.5%. And then what you can do when it quiets down like this, you can buy on the first big up spike. This is called a low cheat, and you could buy like 1/4 of your position. So you could buy 1/4 of your position here, and then you could buy another 1/4 position right here. And then when it gets up to the lip of what is traditionally the handle, what is traditionally the top of the cup, you're going to run into supply, and it's going to make a handle of sorts. And sure enough, that's what Amazon did, and it made this really extended handle. But if you'll notice, this also is a volatility contraction pattern. If we measure the oscillations, we see 20%, we see 23%, we see 11%, we see 3%. So now this isn't going to be perfect. Every oscillation is not going to be smaller than the previous one, but in general you want to just see a settling down of the oscillations. And then like I said, you can buy that first big spike, So if we draw a little trend line here, hold on. Okay, so I put in a little trend line. So this could be your low cheat here. And then when it gets to the top of the cup here, that's another entry point. But there would be an earlier entry point right here. So you could go low cheat. You could go cheat, and then you could buy out of the traditional handle. And what happened after that? Well, one of the greatest stock runs in history, right? From stock split adjusted from what, 20 cents to, gosh, I don't know, $7 over the course of a few years. And if you keep going, the stock takes off like the proverbial rocket ship. Let's not look at the last few months though, shall we? That's Amazon. Let's look at Apple. So essentially you want to just look for a flat base formation with gradually calming oscillations. And this fits the bill. This was October 2004. And if we measure our the volatility, we have 17%. We have 10%. We have 9.9%. And then it calms down 4%. And then it makes this little pivot here of about 2%. And then we can buy on the first big uptick. Here's our low cheat. And we can draw a line across the top of the cup here if you'd like. Okay, there's your cup. And this didn't make a traditional handle, but it made a high handle, didn't it? So you could have bought the breakout expecting for a high handle or for it to pull back into the pattern. And then when it completes, in this case, a high handle, then you could buy one more time right about here. This was in 2004, and Apple made a pretty good run after that, as you know. And I showed you a VCP pattern in Tesla last week. Let me show you one more. This was April 2021. Well, actually, no, sorry. September to December 2021. Let's just measure this out. So we look for a base with contracting oscillations, 36%, 25%, we will say 9.5, 18, 12, 4. So, yeah, not a perfect example, although I suppose you could do that. And it would be a little bit more following our guidelines. But in general, we see a contraction of volatility. This is also known, if I get rid of these, this is also more or less, this particular one is more or less a symmetrical triangle, right? We can do something like this. We can do something like that. Symmetrical triangles can break out in either direction, but since the previous, the action before the base was an uptrend, generally it will continue the trend. And here's your buy point right there. Incidentally, Tesla printed a nice bullish engulfing day today, so we can look forward to probably go up tomorrow. Let's see, here's one you're not as familiar with. This is New Technologies. It is the biggest electric moped maker in China, and it had a mercurial rise and just as spectacular of a fall over the last few years. But let's zoom in on a VCP pattern. I actually bought off of this pattern and made a pretty good profit off of it. So here we are, January 2021. You look for a flattish base, and you just look for volatility contraction. As the name suggests, it's really not rocket science. Let's measure our oscillations. 32%, 17%, 20%, 14%, and then you got a quiet area right here, about 6%. And then here's your low cheat. You buy this big spike, you buy maybe a third or a quarter of your position. And then if you want to, we can draw a line across the top of the cup, like so. So here's your load sheet. Here's your traditional handle. You could buy another third or quarter of your position here in this breakout, and then you can add one more time when it breaks out above the cup itself, and then perhaps on the first, coming off of the first pullback, somewhere right about here. And if you did that, you would have had a pretty good run from, oh, I don't know, 25 to about 50. That's 100%. That's pretty good, right? So in general, you want to look for volatility contracting in most patterns, although not every pattern is a volatility contraction pattern. For example, the double bottom. But we'll save that for another day. Now let me show you two more recent volatility contraction patterns. This has been my best performing stock of the year. Granted, you know, it's been a tough year, so it's, I don't know, not saying that much, but as you can see, it's had a nice run from a breakout of 17 to 44. But let's look at its initial IPO base. Here's its IPO. Now, usually you want to wait a minimum of about a month once a stock IPOs before buying it. Wait for that first IPO base to finish. And essentially, as you know now, we're looking for a flattish base with oscillations that are just calming down. So let's take a look. 22%, 21%, 7%, and then, I mean, these are getting really small, 4%, 3.7%, and then you buy off the first big spike, which I suppose in this case would be right here. Maybe you add, you know, a third or a quarter of your position, although since you're so close to the top of the pattern, maybe you do half of your position, then you can do the other half on the traditional breakout, then maybe add another little bit off of the first pullback. When the stock pulls back, if it pulls back and bounces again strongly, that's tennis ball action. Then that's kind of your last, well, maybe not your last chance, because a lot of stocks will give you one more chance when it bounces off the 50-day average for the first time. This stock doesn't even have a 50-day average yet. This is a 21-day exponential moving average. Now don't go running into the stock right now. It's way overextended. It was up 17% today, but it'll offer us another good spot to get in. I hope anyway. Here's one more, International Money Express, and here we have kind of a dysfunctional looking little cup here, but if we do some measuring, sure enough, it's a volatility contraction pattern. We've got 17%, we've got 16%, and then the oscillations just start getting smaller, 7%, 11%, 5%, 4.5%, 4%. Now, like I said, it's not an exact science, but gradually the oscillations get smaller and smaller. You can draw yourself a little trend line here. You could do something like that. Maybe something like that would look better. Now, unfortunately, this gapped. And gaps are tricky because sometimes the gap will fill, but in this case, this was a breakaway gap. So one thing you can do, if you feel like it's a breakaway gap, you can buy shortly after the gap forms, and you can set your stop a little bit below the open, and you know, you'll get stopped out about 50% of the time, but that's a good way to protect your risk because sometimes it'll fill and go the other way. But so yeah, maybe you buy half of your position here, and then it makes a little bit of a handle. Now this is pretty compressed. We definitely don't have a whole lot of symmetry, but and usually you end up paying the piper. If you don't get symmetry and a nice handle built out to begin with, then a lot of times you'll see a steep pullback, and that's exactly what happened. The stock broke out with a lot of volume, and you know, a good 20% move. Here's your nice volume. But then sure enough, it came back down and pulled back into the pattern because we didn't have a lot of symmetry here. So, and now we've got a new buy point. I actually added to this yesterday. So far, so good. So you could buy, let's say you bought for the first time yesterday, you could have bought a third here, and now it's close to the top of the of this. It's making a cup, right? But we've got a lot of compression over here. This is very vertical. We want to see it build out and make a handle. I'll show you what we want it to do. Hold on. Let's get the old clipping tool, shall we? Here's what we want it to see. We want it to build out a handle like so, and then go, and then we can add some more right there. So in conclusion, yeah, the volatility contraction pattern is a pattern that Mark Minervini identified and often trades off of. It's a lesser known pattern, and a lot of these stocks are not going to have as many eyeballs on them. I mean, Amazon, when it IPO, well, actually, that was a pretty well-known IPO. So scratch that idea. But a lot of times, stocks that are making these VCPs are not as well-known. And you want to get into them and then let them become well-known. And then when everybody knows about them, then you sell. I think that's all I want to say about volatility contraction patterns. If you have any questions or comments about that, yeah, just let me know. Be sure to like the video, and I'll try to get another one out to you soon. Take care.